Welcome to the deep dive.
Great to be here.
Today, we're really zeroing in on those key economic indicators, the ones investors actually need to watch.
Yeah, cutting through the jargon.
Exactly. We've got a list of the fundamentals, and the mission today is pretty simple. Help you understand what they are and, crucially, why they matter for your investment decisions.
Think of it as an investor's cheat sheet to the economy's health.
Perfect. Knowing these signals can definitely give you an edge, right? Without needing like a PhD in economics.
Absolutely. It helps you read the tea leaves a bit better.
Okay, let's jump right in. First up, GDP, gross domestic product. What's the essential takeaway here?
Well, GDP is basically the total value of everything produced in a country. Goods and services.
The big picture number.
The biggest. For investors, it's the broadest measure. Is the economy growing? Shrinking?
So growth usually means more opportunities.
Generally, yes. Companies tend to do better, which can mean higher stock prices. Contraction obviously suggests potential headwinds.
Okay, GDP is the macro view. Now, CPI, Consumer Price Index. We all feel price changes, but how does CPI matter for investments?
Right. CPI tracks the cost of things consumers buy, everyday stuff.
So inflation.
Exactly. It measures inflation. And rising inflation, well, it eats away at the real return on your investment.
The silent killer, yeah.
And it heavily influences what central banks do with interest rates. That's key for borrowing costs and investment choices.
Which leads nicely into interest rates later. But first, unemployment. Seems straightforward, but why is it a critical indicator for investors?
Low unemployment usually signals a healthy economy. More people working means more people spending.
Which fuels company profits.
Often, yes. But there's a flip side. A very tight labor market can push wages up too fast.
Squeezing profits, potentially.
Potentially, yeah. So it's a bit of a balancing act, not always purely good news if it's too low.
Interesting nuance. Okay, how about PPI, Producer Price Index? How's that different from CPI?
Good question. PPI tracks the prices received by producers, companies making this stuff.
Before it gets to the consumer.
Precisely. So it can act as an early warning signal for consumer inflation if producers are paying more for materials or energy.
Those costs often get passed on down the line.
You got it. Shows up later in the CPI. So PPI is worth watching as a kind of leading indicator for inflation trends.
A peek behind the curtain. Makes sense. Now, interest rates. You mentioned them. They seem fundamental.
Oh, absolutely. They're the cost of borrowing money. Higher rates, more expensive for businesses to invest, for people to buy homes or cars.
So it can slow things down.
Definitely acts as a brake on the economy. Plus, higher rates make bonds look relatively more attractive compared to stocks sometimes.
Right, shifts the investment landscape. What about consumer confidence indexes, how people are feeling?
Yeah, it's about optimism. Are people feeling good about the economy and their finances?
And if they are.
They're more likely to spend money? Big purchases, small purchases, that drives economic activity. Low confidence means they might pull back.
So investors watch it to gauge future spending potential.
Exactly. It's a sentiment gauge that can predict behavior.
Okay. Housing market indicator starts, sales, prices. Why the focus here for investors?
The housing market is huge. It's not just about buying houses. Think construction jobs, furniture, appliances.
All the related industries.
Right. And rising home prices can make people feel wealthier. The wealth effect leading to more spending overall. A weak housing market drags things down.
Got it. Big ripple effects. Now, PMI, Purchasing Managers Index.
PMI gives you a snapshot of business activity. It surveys purchasing managers in manufacturing and service sectors.
And what are they asked?
Things like new orders, production levels, employment. It's very current.
So it's a forward-looking indicator.
Yes, considered a key leading indicator. A reading above 50 suggests expansion, below 50 suggests contraction. Gives a quick pulse check.
Useful. Okay, nearly there. Trade balances, exports versus imports.
This tells you about a country's trade with the world, exports minus imports.
And what does that signal?
Well, a positive balance, more exports can suggest strong global demand for a country's goods, indicating competitiveness. A negative balance might mean strong domestic demand for imports, or perhaps weaker exports.
Reflects global economic standing then.
In a way, yes. Competitiveness and demand.
Okay, so wrapping up, we've covered GDP, CPI, unemployment, PPI, interest rates, consumer confidence, housing, PMI, trade balances. That's quite a list.
It is, but they all fit together. They paint a picture of the economic environment.
Understanding these gives you, the investor, valuable context for market movements.
Precisely. It helps you assess the climate, anticipate potential shifts, and make hopefully more informed decisions. They're tools in your toolkit.
So here's a final thought for you to consider. How might consistently tracking just one or two of these measures of name, maybe the relationship between CPI inflation and upcoming interest rate decisions, sharpen your own perspective on market forces over time? Something to mull over after this deep dive.